Morning, everyone. My name is James Erkson. I'm the Director of Community Partnerships and Learning with PANO, and I just want to welcome you all and thank you so much first for the work that you do every day to support your communities, and thank you for carving out the time to learn about compliance requirements for employers today. I know your time is precious, so we really appreciate you being with us. We have a great mix of organizations represented from across the state on today's webinar. And I just wanted to offer, whether you're a current PANO member or not, that I'd be happy to set up a time to talk about how PANO's resources can help your organization advance its mission. So if you're interested, please just feel free to email me anytime at james@pano.org or give us a call. All right, with that, we'll get started with today's program. It's my pleasure to introduce today's presenter, Chuck Whitford. Chuck is a consultant with JRG Advisors, a longtime partner of PANO. His local, regional, and national insurance consulting and sales experience spans 30 years of working directly with mid to large employers. He advises clients on issues relating to healthcare reform, compliance, plan design, funding, and renewal negotiations. Chuck, I really appreciate partnering with JRG on this webinar and you sharing your expertise, so I'll go ahead and turn the floor over to you.
Well, thank you, James. JRG Advisors has been in business for over 30 years. Our corporate office is located in Wexford, which is about 15 miles north of Pittsburgh. We also have offices in Lemoyne, near Harrisburg, and in Steubenville, Ohio. The principals of JRG Advisors created HANP in the early 1990s to serve the nonprofit organizations with health insurance purchasing. Fast forward now, 25 years later, and the mission is to serve, it's still the same, but how we help is so different, as evidenced by our discussion today. Today, it's critical that we provide guidance and strategic preparation for the nonprofits to keep up with the Affordable Care Act, the ERISA, what applies to you and when, etc. We will be taking questions at the end. If you have questions during the presentation, please type it in the question box and press send. We'll also be providing a copy of the presentation after the presentation today. So with that, today we're going to cover the notices that employers need to provide and discuss why every employer needs to take steps to survive a Department of Labor audit. First, let's discuss the key points, and then we'll get into the details. With the ACA, many employers have forgotten or don't realize their obligations that they have to comply with the Employee Retirement Income Security Act of 1974, or ERISA. It was actually the first bill signed into law by President Ford after taking over from President Nixon in 1974. You can see the very top item is have a plan document, a summary plan description for each ERISA qualified plan. This means if you have 2 employees or more under a plan, you need to have a document, small or large. The only groups that are exempt from this are recognized church groups and government entities. Profits and nonprofits alike need to have a summary plan description and a plan document. A certificate of insurance is generally not an SPD, and toward the end of the presentation you'll see the cost of assuming that for some employers. Second thing is, if you have documents, make sure you're delivering them properly by the rules that ERISA sets out. I give an example here. Taking a summary plan description and posting it in a lunchroom or a break room is really not sufficient. And again, you can be fined for improper distribution. You can have a proper document, but if you've got different types of employees, you may have to deliver them differently. And then you also need to make sure you're providing your employees with the special health care notices, HIPAA notices, COBRA, ERISA documents that we're going to go over now. Of course, it's important to pay attention to the Affordable Care Act as well. You must determine if you're in the pay or play category, which is 50 full-time equivalents or more. Although the employer mandate has been waived for 2015 for most groups in the mid-size range, 50 to 99, they still have reporting requirements in 2016 for calendar year 2015. So you need to determine your size what rules you have to follow. If you have an integrated health reimbursement arrangement, or an HRA, don't forget that you need to file Form 720 by the end of next month, July 31st. And we can't stress enough that with all these changes and the increased audits from the Department of Labor, now is the time, as I say there, to utilize the experience of your benefit consultants, the tax and legal advisors. You shouldn't be in this alone. Now, for groups with less than 50 employees, we'll cover some of the requirements that you need to follow. The summary plan description is first and foremost. You should be giving one within 90 days of coverage for a new employee, and you're mandated by law within 30 days of a request, or you're subject to penalties. This is probably one of the biggest triggers for penalties during a Department of Labor audit. It's the lack of a summary plan description, or the lack of producing one in an appropriate manner. Summary of material modifications, so that's really amendments to your summary plan description. You don't need to redo one every single year. You'd want to update it every 5 years, as we've indicated. But there are requirements that if it's normal changes within 210 days after the end of the plan year. However, if you have a material reduction in services or benefits, you have to notify within 60 days. And in addition to that, with the Affordable Care Act, there's something called a notice of modification, which we'll talk about in the next slide, that can satisfy this requirement. I want to stress that insurance company booklets describe the relationship between the insurance company and the employer. ERISA requires a document that describes the relationship between you and your employees and meets the minimum standards of ERISA and the code. So again, the summary plan description, if I leave you with anything today, is a document that you must have prepared and on file. Everybody remembers the health insurance exchange notice that was due October 1 2 years ago, but everyone scrambled to get it out to all their employees, even though the federal government and another arm said that there's no penalty for doing so, even though the law required it. Many folks know this, but some don't, that you need to put this in your new hire packet for all employees, whether you provide insurance or not, whether they're eligible or not. Each person should get within 14 days of hire this notification that just lets them know what their rights are under the marketplace. The summary benefits and coverage is undergoing some big changes. On the 16th of June, the Department of Labor issued final regulations that affects coverage that begins September 1st and on. There's a new template. We expect another revision in 2016 to take effect in 2017. There's a $1,000 fine for each, as they say, willful failure to provide an SBC when you need to do that. And it's commonly accepted during each open enrollment period and within 7 days of a request to most often used deliveries. There's also that notice of modification I mentioned. If you make a change that's not in conjunction with your renewal, you must give a 60-day notification. This is separate from the ERISA rules on the prior page that said you can issue something 60 days after or 210 days after, depending upon whether it's a reduction or not. This is an ACA requirement, and you need to comply with both sides of the law. And this notice of modification will probably satisfy the ERISA requirement of getting notification 60 or 210 days later. Now, there are few employers make changes off cycle, so we don't really see this used a lot, but you need to be aware that if for any reason you're changing a plan, you need to give that proper notice. There are fewer and fewer plans that haven't changed since the bills were signed into law in 2010. If your plan has not changed and you are considered in grandfather status, you need to disclose that anytime you issue plan materials to a participant. Again, there are fewer and fewer employers that have not made changes to their plans in the last 5 years. And in some instances, insurance carriers at the beginning of the implementation of this law caused many employers to lose any chance of grandfathered status simply by shifting coverage from one company to another subsidiary company. So very few plans are out there are still grandfathered. But be aware that that's going to be something you'll need to have in your records. The notice of patient protections, again, that's any plan that requires a primary care provider to be selected. You have to provide this document. Most plans are fairly open. So you can select any provider that's in the network and not sign up with a particular one. So it doesn't apply in a lot of cases. I mentioned before about paying the PCORI fee. That's a patient-centered outcomes research institute fee. This is to fund best outcomes studies by the government to determine what they will cover in the future in terms of treatment, both within Medicaid and Medicare, and of course it would spill on to the exchanges and go to the insurance companies as well. If you have a self-insured plan, you need to file this Form 720 by July 31st. I would consult your tax counsel on the details. If you're in a fully insured plan, the fees are paid by the insurance carrier. And this does not apply to standalone dental, vision, accident-only plans, disability income, etc. But if you have a fully insured health plan and you are providing a health reimbursement arrangement to your employees on a self-funded basis, you need to learn about this and pay your fee by the end of July. Now the next few have to do with complying with HIPAA. Notice of special enrollment rights. This really just covers what we refer to as the Section 125 qualified status changes that allow people to come and go in your plan if they have certain circumstances happen. Wellness program disclosure. Wellness programs have been in the news a lot lately. You know, the Affordable Care Act actually encouraged employers to create wellness programs, active, we call them health contingent wellness plans, that allows you to issue rewards or penalties to employees for achieving certain goals. Over the past year or two, the EEOC, Equal Employment Opportunity, have come down hard on wellness plans that penalize employers. And there was this big fight going on. Congress was working on a bill to answer some of the unanswered questions about who's right and who's wrong. Well, the EEOC has just come out with an 80% of the answer so far. In compliance with the ACA, there are a few areas that still need to be worked on, and we would expect something more detailed toward the end of the year. But if you have a program and you are trying to describe it's a health contingent wellness plan, meaning, again, they get rewarded or penalized based on meeting certain standards related to health, you need to provide the wellness program disclosure form. Notice of privacy practices. Again, if you're a fully insured employer and you create or receive protected health information, this is not summary health and enrollment info, experience reports that don't identify specific people. That's okay. But if you're actually handling and self-administering these programs, again, you need to provide this notice. And that goes into detail how your information is used and how it's protected primarily. COBRA still exists, although the insurance marketplace out there, the exchanges, I believe, are making it irrelevant. It's still a law, and you still need to comply, even though there are probably more attractive options for a lot of employees that need the coverage than electing to stay on your plan and pay 102% of your cost. But you still have to provide a general notice of COBRA rights within 90 days. So again, put something in your new hire packet. COBRA rights have to be in the SPD that you need to have. Then, of course, process, if you have a qualifying event, there are notices. You have to notify an employee within 30 days of these issues: death, termination, reduction in hours, talent to Medicare. The participant, the employee, needs to let you know within 60 days of divorce, separation, or loss of dependent status. And then that follows the COBRA election notice, again within 14 days of obtaining the qualifying event notice. You can notice the asterisk says, COBRA applies to groups of 20 or more employees. So those with less than 20, you'd be subject to the state continuation rules. COBRA notices continue. On the next slide, notice of unavailability of COBRA coverage. There are some situations where you're not eligible for it. Underpayment of COBRA premium. This has been a big thing that in the last year or two, that a lot of people were being termed because they were off by $20 on their COBRA payment. Although the government doesn't define what a small deficiency is, you need to give a grace period of not less than 30 days if you receive not quite all of the premium. You just can't terminate them off of COBRA. And that notice is important. And then obviously you need to notify them if they're terminated before their 18 or 36-month period ends. Other special health notices: Women's Health and Cancer Rights Act. You need to provide that at an enrollment in a plan, and then once a year. Michelle's Law is not as, it's become less relevant after the Affordable Care Act allowed anyone to stay on coverage to age 26. But before that law was passed, it allows students to have up to a year of coverage if they're unable to be a full-time student because of an illness. And so, that, again, you need to just know if you need to provide that, but we don't see that much anymore. The CHIP notice, Employer Children's Health Insurance Notice Program. It's always a good trivia fact that the CHIP program started in Pennsylvania. You need to provide that once a year before the start of each plan year to all employees. And we suggest that you offer it at the same time that you provide the summary plan description. The Newborn and Mother's Health Protection Act notice has to be in your summary plan description. It's the best place for it. And each fall, employers need to make sure they send out the Medicare Part D credible coverage or non-credible coverage notice, basically saying whether the drug plan they offer, people who are eligible to take the Medicare drug plan, whether it's of equal or better value than what they could get under Medicare. And it's always a debate with insurance companies as to whether their plans are credible or not. And as we see the move from co-payments in prescription drug plans, which are all credible, to large deductibles, which include both medical and prescriptions, people need to make sure that they have a big deductible, that it does still meet the credible coverage levels, or they need to issue a non-credible disclosure. This all has to be done each year before October 15th to Medicare eligible individuals. You ask, well, how do I know if they're eligible? Well, you don't, because we could also be talking about dependents. So it's generally thought that you would provide that to all employees with the expectation that if any of the dependents are Medicare eligible, this satisfies your obligation under the law. If you have 50 or more employees, you have a few more obligations. First off, you have the same as the list for employers, the list of 50 we just covered. You might have to provide a Mental Health Parity and Addiction Equity Act disclosure upon request, assuming that your plan does provide both medical, surgical, and mental health or substance use disorder benefits. Again, we don't really see that. Then people requesting it. And then we get in the area of family medical leave. If you have 50 or more employees within 75 miles, you're considered in general needing to provide that benefit. A notice has to be posted prominently in your place of business, and you have to include this in any written information concerning benefits or leave rights. Now, the process is within 5 days of an employee notifying you that they're going to be taking FMLA leave, they have to provide this notice of their eligibility and rights. The designation notice follows within 5 days after the employer is determined whether the leave is really qualifying or not. Sometimes it doesn't meet the qualifications. On top of all that, for very large employers and groups of 100 or more employees, under the health and welfare side of things, you need to file Form 5500 each year. It has to be done electronically, and it's by the end of the 7th month after the end of the plan year, so July 31st is a common date for the calendar year plans. And then each employee needs to get a summary annual report within 9 months after the end of the plan year. Again, this really applies to groups of 100 or more employees. Let's look ahead briefly at 2016, and that's the year the reporting begins. There are 2 codes that come into play. Code 6056 requires applicable large employers. We keep coming up with new titles for folks, always 3 initials, never 2 or 4, ALEs, to provide an annual statement detailing the employee's health coverage. And then code 6055 requires employers of any size that provides minimum essential coverage to provide an annual statement. Unless there is some form of relief issued from Washington, all groups of 50 or more full-time equivalents will have to file informational returns in 2016 for calendar year 2015. Even if you were exempt from the employer mandate in 2015. Again, stay tuned. That could change, but we know nothing at this point. So what are the forms? Well, IRS Form 1095-C, you have to complete this for each full-time employee, and which means you need to track information listed below it. This is just a partial list. If we're able to provide that, you need to provide a copy to each full-time employee by the end of January. And, of course, this is sent to the Internal Revenue Service with a transmittal form called 1094-C, and it talks about whether you offered coverage to 70% of your full-time employees. Remember, the transition rules allow you to offer to 70%, not 95%, which is under the original law, which takes effect in 2016. The total number of 1095-Cs you issued, full-time employee counts by month, total employee counts by month, and very important, whether you're eligible for certain transition relief, particularly those in the 50 to 99 full-time equivalent category. And there are codes for all of these things. It's also Forms 1095-B and 1094-B. Employers who are not in the applicable large employer size that offer self-insured plans that provide minimum essential coverage have to file using these forms, drafts of which were just released last week. You can't use those forms yet. There's simply draft versions, and expectation is that we're going to get the actual forms later this year. And we want to end this presentation with talking just about Department of Labor enforcement and audits. They have, as I mentioned here, they've got a broad authority to investigate and audit employer benefit plans compliance. ERISA, the Employer Retirement Income Security Act, was really initially established on the qualified plan side to regulate pensions and things like that, but it was also extended to health and welfare programs that you provide to your employees. They're increasing their auditing because of the Affordable Care Act. They are systematically auditing employers, and while they're there for compliance with the ACA, their original compliance obligation is with ERISA. So we need to be careful with both. How does an audit happen? Well, they don't really come knocking at your door. The employer, the plan sponsor, which is usually the employer, will receive an initial document request in a letter from the regional office, and they'll request documents. Sometimes the request goes to the providers first, and then the plan sponsor. So hopefully you have a good relationship with your providers, or maybe will tip you off they've received an inquiry. And the documents they ask for can go from a few pages to volumes of documents. Common things are insurance policies and riders, service provider agreements, always the summary plan description, and the other forms I've mentioned, the summary of material modification, summary annual reports, 5500s for the past 2 years. The list can go on and on. You need to reply promptly, ask about the purpose, the scope, and the timing of this, and then ask for an extension. You usually can get 2 or 3 weeks. That gives you time to gather your documents, consult an attorney. There's often an on-site visit where they'll look for booklets and forms and payroll records. They'll conduct interviews with multiple individuals to verify what's been said and done and shown. At the end, they'll identify potential ERISA violations and then produce a settlement agreement. So that's kind of the process. So it's really, really important to have good records and make sure you've got all the documents that are required by the law. You can see that in 2014, here are the statistics from the Department of Labor regarding both civil and criminal investigations. The 2 biggest reasons for an audit: a participant complains, so if you have an upset employee or former employee, that's a big trigger for one. To keep your employees happy, ask for forms, don't delay. If you are confused as to your obligation on providing a form or information, contact your benefits consultant. They can help you. The other way is when the Department of Labor has a program to systematically audit employers, and they have one called the Health Benefits Security Project. And this is what we're most concerned about, is the systematic audits of all employer groups of all sizes for compliance. And don't forget, participants, employees, can also sue the welfare plans, as well as a plan administrator and other plan fiduciaries. There's an awful lot of importance in doing all you can to show good faith compliance with the laws. I'm going to finish with some of the penalties. Criminal penalties can be up to $100,000. That's where no document exists. Failing to provide a copy of a summary plan description within 30 days results in a minimum penalty of $110 per day per employee. Willful failure, meaning you know the law, you're ignoring it, to produce documents, could equal $100,000, a maximum of $500,000 per company, or imprisonment. A couple notable examples, these various cases. The first one, $10,560, failure to send an SPD in a timely fashion. In this situation, in late 2008, Bank of America changed their insurance carrier. In March the following year, an employee asked for the plan documents. They were sent 2005 handbook, a brochure, other information, not the summary plan description. Finally, almost a year later, the person filed suit to get summary plan description. That's what resulted in this penalty, the ruling. Sandoling versus First Reliance Standard. This has to do with a disability benefit dispute, and found that there was no SPD when the counsel for the plaintiff asked for the SPD for the trial. They were hanging their hat on the fact that a certificate of insurance was enough, as many people feel. And while there are a few, particularly in the life and disability area, a few companies that do provide a summary plan description with certificates, almost all medical plans and other certificates are just that, certificates, not SPDs, that cost almost $18,000. And the last example has to do with life insurance benefit changing. The individual was not providing an SPD about the change regarding it, and of course the person passed away, and there was a lawsuit over what the benefit should have been, or he thought he had, wasn't notified that it had been reduced. So with that, I'll be happy to open up to questions. A lot of these may be of a very technical nature, so we will be cautious to only give the answers to the questions we know very well, and others we will research and then provide a feedback on the questions to the folks that are on this webinar. Any questions, Janet?
If you have a question, please type it in the questions box and hit send.
And remember, the presentation will be available later for you. We certainly appreciate that you taking the time this morning to cover this topic.
Yes, we have recorded the webinar as well, so we'll provide you with a copy of the PowerPoint presentation as well as a webinar replay.
JRG Advisors does provide some services in these areas. One of the main reasons why I've had to learn all these facts and figures, and we're happy to share our expertise with our clients on these important areas. Well, there are no questions, so either I've done a wonderful job. Oh, we do have a question. There goes that.
We just had a question come in. If you're an employer with less than 50 employees, ACA does not apply. Is that correct?
Well, the employer penalty part of ACA would not apply if you have less than 50 full-time equivalent employees in the prior calendar year. So in 2014, you add up all your 30-hour and more people on one line. You accumulate all the hours of your part-time folks, no more than 120 in any given month. Divide by 120 each month. That gives you your partial person. Add them up over 12 months. Divide by 12, and that's your average. If it's 49.99, you're not subject to the employer mandate. However, you are subject to the market reforms of the Affordable Care Act as a small employer. So doing the math is very, very important, particularly if you're just slightly below 50. These part-timers can really add, can throw you over at the end. And then there are different rules about seasonal employees and seasonal workers too that can change that math.
The next question, are there any templates for the SPDs that we need to provide?
Well, summary plan descriptions are generally provided through attorneys with fees varying. We've seen from $1,000 to $2,500 depending upon your complexity. We have invested in a program that will allow us with the risk attorneys to provide those documents, but there isn't any mandated template by the government exactly what the form has to look like.
The next question, do you know if the 1095 form are available in an electronic format to fill the information in on the computer?
You know, I really am not 100% sure whether it's, I would imagine. It's available online. Whether it's available in a writable PDF form, we'd have to double check. I don't know the answer to that off the top of my head.
The next question. So no matter the size of the organization, the health insurance exchange notice must be in the employment package.
Yes, and that's whether you provide coverage or don't, whether the employee is eligible for coverage or not. The government really wants every person employed by every employer to know about the marketplace, and that's the function for that.
The next question, can I assume that my benefit advisor who handles our insurance is meeting most of these requirements? They give me information and I provide it to my employees.
Well, that's a great question. Gosh, we'd be happy to look at whatever they're providing to tell you whether it's in compliance or not. And, but really, unfortunately, ultimately, the employer is the one that bears the brunt of any penalties. So that if you're not being provided with the proper documentation, you know, it can cost you. I guess that's the best answer I can give under the circumstances. You can never assume anything. Hopefully, the slides in this presentation might be of some help to compare, to sort of audit what you're getting from your advisor to see if any of these things are missing. Of course, everyone's situation is a little bit different.
Do we have any more questions?
All right. Well, I thank everybody for their time this morning. Our contact information is available, and we'd be happy to talk to anybody about their compliance needs. And thank you very much. Their compliance needs. Thank you.